Is the stock market in a summertime consolidation period? Is the bull trend still intact? Well, for answers to these and other questions, we bring in Zacks chief equity strategist and economist, John Blank. John, what do you think about that?
Well, Terry, the simple answer is I'm very bullish on the NASDAQ because it rolled over earlier at first this year, back in February. I am getting bullish on the S&P 500 because it's now turning up with the NASDAQ and has been struggling and consolidating for longer than the Dow. And the Dow is the one that seems to be lagging a little bit. So it seems like the market is moving back to big tech stocks and then chasing that momentum higher in the summer here. And the one thing that remains out there is whether the Dow starts to go higher. And that's also what I expect, but it might be delayed for a few weeks.
So if it does move higher, then it's a pretty broad-based consolidation at that point. Why a summertime share index consolidation versus maybe fall or later in the year?
Well, first of all, the volumes typically drop off in the summer. A lot of people take vacations. And also, there's a kind of a phenomenon in my mind where people are not getting earnings reports. They're not looking into 2022 just yet. When you get to the fall, everybody's attention turns to next year, and all the numbers that were put out for this year become irrelevant. And so the market somehow doesn't seem to be liking 2022 until basically September. Basically, earnings season gets over and everyone looks ahead.
The markets listened closely to anything new the Fed had to say after its last meeting, which was just recently. What was the takeaway from that?
My takeaway from the Fed meeting is there was nothing we learned. They raised the CPI core by a point above 3 for this year, which is only acknowledging facts. It's not an outlook. And their outlook for next year, which does matter, went up 1/10 of a point on the CPI, which is basically irrelevant. So I took away from the Fed that they are beginning to accept that inflation is higher than they thought this year, but they're not yet ready to accept that that's going to linger across next year. And that is why the 10-year Treasury rate stayed at 1.5% after that meeting, because the market did not get the impression, regardless of what people are saying about tapering and interest rate increases in 2023 that they announced, all of that is and should be reflected in both stocks and the 10-year. And obviously, with stocks going up right now and the 10-year being flat, none of that's anything but cheap talk and not being taken seriously by this market.
What do you make of that decline in the 10-year Treasury?
I think it's just telling you that the Fed's stuck after 12 years of money printing and government deficits that have been in the trillions. A government with trillions of dollars in new debt simply cannot let interest rates rise. And a Fed that's completely reliant on stock market wealth as its one of its core consumption drivers also cannot let go of this. So the market is just telling you what everybody knows. The Fed's stuck.
So with the Fed continuing to print money for the foreseeable future, then, is there still market anxiety out there?
Yeah, there is market anxiety. I think it's always tough to call turns, but the market anxiety here is around the taper, but more importantly, that this is going to cause some shift in the momentum of the stock market itself. And until we see that, I wouldn't worry about it. And that's basically the problem here is consolidation periods don't really change the consensus about momentum trading. They just actually improve it because people think, oh, they're going sideways now, they'll move up again. So I think this market still wants to momentum trade, and until that rolls over, we're not going to have to worry about this market.
Is that momentum trade what's going to be shaping stock prices for the second half?
I will leave that open to the market. Mr. Market can decide that, Terry. That's what I think.
Okay. What role, if any, will corporate earnings be playing in stock pricing?
Well, they are going to be extremely strong for the next 2 quarters, and that will support the stock market. And I think it's going to carry on into 2022 too, which is, as we talked earlier, that will start to be the story for the stock market and in the headlines by September or so.
All right. Meantime, you're looking at 3 top auto stocks: General Motors, Stellantis, and CNH Industrial.
Yeah, these three are all, for long-term scores, A's and B's across the board of value, growth, and momentum. And they're number one stocks. And what's interesting about this is, why is this the case? Well, basically, as we talked about our other podcast we did today, is auto lots inventories across the United States are very, very depopulated by demand and by the chip shortage. So General Motors and Fiat and CNHI, which is a supplier of parts, are getting great prices for the new vehicles they are making, and that's causing estimate revisions to go up for the new car makers in the United States. So there's a bull case right now to be known about, which is in traditional automakers. Stellantis is basically Chrysler, Audi, and GM is obviously GM. And this is something to look into. I would point out further that these three stocks together make up about $157 billion in market cap. Tesla is at $600 billion in market cap. So Tesla still remains 12 times the size, basically 12 auto companies in one, according to the market. And I'm still believing that's an excessive number. And it does say, though, that there's a huge other win that's not being priced in with this Stellantis and GM move, but is going to be when their electric vehicle production ramps up.
Interesting. Well, that's the market picture from our chief equity strategist and economist, John Blank. With John, I'm Terry Ruffalo. And here's something for you to check out. Zacks just released a special report revealing 8 stocks poised to blast higher on the $4 trillion travel recovery. So go to Zacks.com/promo for details, but don't wait too long because there is an ending date to that offer.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.